Okay, so you want to own a Holiday Inn Express. Business travelers book it without reading reviews. Banks lend against it without blinking. It sounds like the safest bet in the entire hospitality industry. It is not. The total investment to open a single 93-room Holiday Inn Express can run past $11 million before a single guest checks in. By the end of this video, you'll understand how much of every room you sell actually reaches your pocket, and why some owners walk away rich while others lose the hotel entirely. That's exactly the kind of thing this channel exists to unpack. Subscribe for more. Let's start with the number that's supposed to be the easy part, what it costs to get in. Here's what surprises most people first. The franchise fee, the actual price of the right to use the name Holiday Inn Express, is almost nothing compared to everything else you're about to spend. Intercontinental Hotels Group, or IHG, is the company that actually owns that name, and it charges $500 per guest room for it, with a minimum total of $50,000, regardless of whether you're building a 60-room property or a 150-room one. That fee buys you the sign. It buys you almost nothing else. Everything underneath that sign, you're paying for yourself. According to HVS's 2025 U.S. Hotel Development Cost Survey, the median construction cost for a limited service hotel, the exact category Holiday Inn Express falls into, sits at $167,000 per room. For a 93-room property, that's the land improvements, the steel, the HVAC, the elevators, the furniture in every single room before you've paid IHG a single ongoing fee. Run the full math on a typical 93-room build, and franchise disclosure filings put the total investment, excluding the land itself, between $7,881,597 and $11,081,667. Let that second number sit for a second. $11,081,667 for a hotel with fewer rooms than a single floor of most downtown office towers. Here's the part that should really worry you. That number assumes everything goes according to plan. New construction, current market pricing, no delays. Most people who buy into this brand aren't building from scratch. They're buying an existing property. Sometimes one that already carries the Holiday Inn Express flag, sometimes one that used to be something else entirely and needs to be converted. And conversions come with a document that new construction usually doesn't, a property improvement plan, or PIP, handed down by IHG the moment you sign. We'll come back to exactly how expensive that document can get, because it's the single biggest hidden cost in this entire business. But even before that, the entry price itself already tells you something the brochures don't. Nobody's building these from the ground up anymore unless the math on a specific piece of land works out perfectly. Construction costs have made new build economics brutally tight, so the overwhelming majority of Holiday Inn Express transactions today are existing hotels changing hands, not new ones going up. Which means the price you actually pay isn't set by construction costs at all. It's set by whatever the previous owner's lender is willing to accept to get the loan off their books. That single fact splits every Holiday Inn Express you'll ever walk past into two completely different financial stories, and you won't be able to tell which one you're looking at just by standing in the parking lot. Take the Holiday Inn Express on North Wabash Avenue near Chicago's Magnificent Mile, a 174-room property previously known as the Hotel Cass that fell into foreclosure during the pandemic when its owners defaulted on their loan. In 2024, it sold at auction to a Florida-based investor for $16,430,000. That works out to $94,425 per key, less than what it would cost to build a single, limited service room from scratch for a fully constructed, brand-affiliated hotel 3 blocks from one of the busiest shopping districts in the country. Now compare that to a Holiday Inn Express roughly 1,800 miles away, in Washington, D.C.'s Mount Vernon Triangle. Its owner had borrowed $49 million against the property. By the time the loan ballooned with late fees and unpaid interest, the balance owed had climbed to nearly $80 million. At the foreclosure auction, the lender itself was the only bidder and won the property for $18,500,000, 77.7% below what was actually owed on it. Same brand, same green sign, same breakfast bar, two buildings that tell you almost nothing about what you're actually buying until you understand exactly whose mistake you're stepping into and at what price the market decided that mistake was worth. There's a reason banks are willing to fund either version of that story. A branded, franchised hotel is simply an easier loan to underwrite than an independent one. Lenders already know the brand's performance data. They already know what a Holiday Inn Express is supposed to generate in a given market, which means they're more comfortable extending credit against it than they would be for an unbranded property with no track record at all. That's part of why so much of this industry runs on debt in the first place, and why the size of the loan against a hotel, not just the price tag, can decide whether an owner survives their first bad year or not. So before a single dollar changes hands, you have to answer an uncomfortable question. Are you buying a functioning business, or are you buying somebody else's unpaid debt with a hotel attached to it? Because the answer to that question determines everything that happens the moment the doors open and the money starts moving. How the money flows. A Holiday Inn Express doesn't hand its owner a check for the full price on the door. That number is just the starting line. What actually reaches the owner's pocket gets whittled down through a stack of fees so automatic, so built into the franchise agreement, that most first-time buyers don't fully grasp how deep the stack goes until they see their first monthly statement. Let's follow one room on one night and watch what happens to the money. Say your 93-room property runs at the national mid-scale average 68% occupancy and an average daily rate of $148. Across a full year, that's 23,082 room nights sold, generating gross room revenue of $3,416,225. That's the number on the sign. It is not the number you keep. First comes the royalty fee. IHG takes 6% of gross room revenue off the top, whether that room was booked by a loyal Priority Club member or an accountant who found the cheapest rate in town. On our example hotel, that's $204,973. Gone before you've paid a single housekeeper. Then comes the marketing fee. Another 4%, this time funding the national advertising campaigns and the reservation system that, in theory, is bringing you those guests in the first place. And that's $136,649 more. Then there's the technology fee, $17 per room per month, regardless of whether that room was occupied or sat empty. Across 93 rooms for 12 months, that's $18,972, a fee you owe just for the privilege of existing inside IHG's booking system. Add those three together, and $360,594 of your gross revenue, more than 10.5% of everything the hotel took in, has already left the building before you've paid rent, payroll, insurance, or a single utility bill. And if you're not operating the hotel yourself, if you've hired a third-party management company to run daily operations while you stay hands-off, add another layer on top. Management fees on limited service hotels typically run 3 to 4% of total revenue. Another $102,487 to $136,649 gone before operating costs even start. That's the difference between an owner who shows up every day and an owner who simply collects a check. Both are legitimate ways to hold this asset. Only one of them keeps that extra percentage point in your own pocket instead of someone else's. Even the fees you've paid so far are only the ones IHG and your own management company collect directly. There's a second toll booth you haven't reached yet, and it belongs to somebody else entirely. If numbers like these are new to you, that's the point of this channel. We break down what a business actually costs, one industry at a time. Subscribe if you want the next one delivered straight to you. The hidden costs. If you thought the brand fees were the whole story, here's the part nobody puts in the brochure. Every business has an entity taking money away from the owner. In this business, that entity is IHG itself, through a mechanism buried inside the franchise agreement, the property improvement plan. Before we get to that, there's a smaller drain worth naming first. A meaningful share of your bookings won't come from IHG's own reservation system at all. They'll come from Expedia and Booking.com, two companies that will happily fill your rooms for a price that makes the royalty fee look small by comparison. Expedia charges hotels between 18 and 25% commission on every booking that comes through its platform. Booking.com runs 15 to 22%, sometimes higher if you've enrolled in one of their preferred visibility programs, which in practice means paying more to be seen at all. Say a third of your bookings, $1,195,679 of that $3,416,225 in annual room revenue comes through these platforms at a blended 20% commission. That's another $239,136 gone to a company that never once cleaned a room, checked in a guest, or fixed a leaking pipe. Between the brand fees and those commissions, close to $600,000 of a $3.4 million hotel's revenue has left the building before a single operating expense is paid. That's nearly 18 cents of every dollar this hotel generates gone to entities that own no part of the physical building at all. And that's the version of this business where nothing goes wrong. Here's where the real damage happens. Buried inside every Holiday Inn Express franchise agreement is a clause that gives IHG the right to demand that property improvement plan whenever it decides the hotel no longer meets brand standards. This happens every 6 to 10 years, and it is not optional. Refuse it, and IHG can terminate your license to use its name, and these aren't small requests. SEC filings on hotel-backed commercial mortgages show exactly how large these numbers get in practice. One Marriott property required a PIP with an estimated total cost of $8 million, working out to $25,397 per room, more than half of which went toward guest room renovations alone. A separate portfolio of IHG-branded hotels was hit with $4,507,400 in required PIP renovations, all mandated by the same franchise agreement the owners had signed years earlier, believing they understood the deal. Then something changed. The math on one real-world example makes the trap obvious. A $500,000 PIP on a 50-room hotel paired with the best-case outcome, a $5 increase in average daily rate, and a 5% bump in occupancy still takes 5.81 years just to pay itself back. And that number doesn't even account for the lost revenue while the hotel sits partially under construction, rooms out of service, guests turned away during the exact window you're trying to recover the cost. And the timeline is rarely generous. Most PIPs must be completed within 12 to 18 months of the notice date, with design submissions due within 90 days of receiving it. Miss those deadlines and the consequences escalate quickly, up to and including termination of the franchise agreement itself. That means an owner who doesn't have several $1 million in reserve or the ability to borrow it fast isn't just facing a renovation. They're facing a countdown clock on whether they get to keep the business at all. This is the villain of this business, and it isn't a person. It's a clause, a recurring, non-negotiable, franchisor-mandated bill that arrives on someone else's schedule, sized by someone else's inspectors, funded entirely out of your reserves, your loan, or your operating cash flow, whichever one you're least prepared to lose. The owner who thought they'd bought a stable, cash-flowing asset discovers the truth the moment that PIP notice arrives. The hotel was never fully theirs. It was theirs to maintain at IHG's discretion on IHG's timeline for as long as they wanted to keep the sign. And that single realization is the moment this entire business stops looking like real estate and starts looking like something else. Here's the reframe that changes how you see every Holiday Inn Express you'll ever drive past. You don't own a hotel, you rent a name, and you're the one paying to maintain the building it hangs on. Think about what actually happens across the life of that franchise agreement. Every month, 6% of your gross revenue leaves for the royalty fee. Every month, another 4% leaves for marketing you didn't design and don't control. Every month, $17 per room leaves for a reservation system you're required to use. Every 6 to 10 years, IHG hands you a multi-million-dollar renovation bill you didn't request and can't refuse. And in between all of that, a third of your remaining bookings get intercepted by Expedia and Booking.com before they ever touch your own reservation desk. What's left after all of that is what you actually own. Not the brand, not the guest relationships, since a Priority Club member is loyal to Holiday Inn Express, not to your specific hotel off exit 47, not even the pricing, since IHG's algorithms and brand standards shape what you're allowed to charge and how you're allowed to present it. What you own is the building, the debt against the building, and the obligation to keep both of those aligned with a brand standard you don't set. That's not a hotel business. That's a real estate holding company that pays rent in the form of fees for permission to keep the tenant in the form of guests coming through the door. Compare it to what a diner owner or a gas station owner deals with, and the pattern gets sharper. A diner owner competes on food and service. A gas station owner competes on price at the pump. A Holiday Inn Express owner competes on almost nothing, because the brand has already decided what the breakfast looks like, what the lobby smells like, what the front desk script sounds like, and what happens if you deviate from any of it. The upside of that arrangement is real. You inherit demand you didn't have to build yourself. The downside is just as real. and far less advertised. You inherit an obligation you can't walk away from without losing the very thing that made the investment worth making in the first place. Which raises the only question that actually matters if you're deciding whether to buy in. If the brand controls the pricing, the standards, the renovation schedule, and takes over 10% of every dollar before operating costs even start, where exactly does the profit come from? And who's actually capturing it? Who actually makes money? The people who make real money in this business almost never look like the people the franchise brochures are marketing to. Anand Patel is one of them. A former hedge fund manager, he joined his family's hospitality business in 2013 and built a Holiday Inn Express from the ground up in Berkeley, California. In his own account of the decision, the calculation wasn't about the brand's advertising promises. It was about which company delivered the most reservations relative to what franchisees paid, and IHG, alongside Hilton and Marriott, topped that list. Location mattered just as much. Holiday Inn Express didn't yet exist in Berkeley's South Bay area when Patel built there, meaning the market wasn't saturated and the return projections were stronger than they would have been anywhere already crowded with the same green sign. But Patel's story, as instructive as it is one hotel. The pattern behind who actually wins in this industry is bigger, and it's been building for 50 years. Today, Indian American families, and specifically families surnamed Patel, own more than 60% of all hotels and motels in the United States, more than 20,000 properties, despite Indian Americans making up less than 1% of the country's population. It's not a coincidence, and it's not one lucky family. It's a documented pattern that traces back to the mid-1970s, when the oil embargo crushed the roadside motel industry and left a wave of distressed properties that conventional banks and insurers wouldn't touch. First, they bought the properties nobody else wanted. Distressed motels, available outright for as little as $40,000 during the 1970s slump, when gas shortages had gutted demand for exactly the kind of roadside lodging that later evolved into brands like Holiday Inn Express. Second, the family was the labor force. Immigrant owners ran the front desk, cleaned the rooms, and fixed the plumbing themselves, rather than paying out a significant share of revenue in wages the way a conventionally staffed hotel would. The business came with a house attached. You didn't need fluent English, you needed the willingness to work every single day. Third, they financed each other, not the banks. Conventional lenders wouldn't extend mortgages to these early immigrant owners, so families relied on informal community lending, sharing down payments, and partnership stakes within a tightly networked group long before institutional capital would touch the sector. Fourth, they followed a strict cash flow discipline. 4 times cash flow became the informal rule. If a distressed property produced $10,000 a year in revenue and could be acquired for $40,000, it was worth buying. Renovate it, improve the cash flow, sell it, and trade up to a better property. Repeat. Fifth, they never stopped moving up the brand ladder. What started with independent, unbranded motels graduated, over decades, into recognized names like Econo-Lodge, Days Inn, and eventually into premium brands like Holiday Inn Express. Each step funded by the equity built in the last property, not by outside investors cashing them out early. The Asian American Hotel Owners Association now represents members who collectively own properties worth an estimated $1 trillion, employing more than 1.1 million people nationwide. That scale didn't come from chasing the brand's marketing promises. It came from buying distressed assets at the bottom, running them with family labor instead of payroll, and reinvesting every dollar of profit back into the next acquisition for 2 full generations before the big institutional money ever noticed the opportunity was there. Sixth, and this is the part conventional operators consistently underestimate, they treated the property as a multi-generational asset, not a 5-year flip. First generation absorbs the labor and the risk. Second generation professionalizes the operation and expands into recognized brands. Third generation inherits equity in properties that have already been fully de-risked, PIPs already absorbed, debt already paid down, decades before a conventional institutional buyer would even consider entering that same market. That's the pattern hiding underneath every Holiday Inn Express sign you drive past. Somebody is collecting the brand fees, somebody else is absorbing the PIP costs and the OTA commissions, and somebody, usually the person willing to do the labor themselves and wait a decade for the equity to compound, is the one actually walking away with the money. Which brings us to the only question that decides which category any specific hotel and any specific owner falls into. Let's run two real scenarios, side by side, using the actual numbers this industry operates on. Scenario 1. The conventional path. You build a 93-room Holiday Inn Express from the ground up, spending $167,000 per key on construction for a total development cost of $9,663,000, the midpoint of the franchise's disclosed investment range. You borrow 65% of that at 7.2% interest, paid back over 25 years, which puts what you owe the bank each year at $550,700. The hotel opens and performs at the national mid-scale average 68% occupancy, $148 average daily rate. Annual gross room revenue, $3,416,225. Now the fees. Royalty at 6%, $204,973. Marketing at 4%, $136,649. Technology fee, $18,972. OTA commissions on a third of bookings at a blended 20%, $239,136. Total revenue leakage before a single operating expense, $599,730, leaving $2,816,495 in net revenue actually available to run the hotel. Across the hotel industry in 2025, after paying for housekeeping, front desk staff, utilities, and supplies, the average hotel keeps 34.8 cents of every net dollar. Applied here, that's $980,140 left over. Subtract property taxes, insurance, and the other fixed bills that come with owning the building, and what you actually keep drops to 22.8 cents of every total dollar the hotel brought in, or $778,900 for the year. Subtract your $550,700 owed to the bank, and you're left with $228,200 in your pocket. You put in $3,382,050 of your own cash to make this deal happen. That means you got back 6.7 cents for every dollar you invested in a good year, with no PIP notice on the horizon. Now run that same hotel through year 7 when the PIP notice arrives. Based on real filings, a mid-size renovation of this scale runs somewhere between $2,300,000 and $4,500,000. Even at the low end, that single mandatory expense wipes out more than 10 years of the cash flow this hotel was projected to generate, and it has to be paid regardless of whether the hotel had a strong year or a weak one. Stretch that same PIP across a financed reserve instead of paying it in cash, and the owner is now servicing two loans simultaneously, the original construction debt and a fresh renovation loan, against a hotel whose revenue hasn't grown to match either one. Occupancy typically dips further during the construction period itself, since guests actively avoid hotels with active renovation work, which means the very months an owner needs maximum cash flow to service that new debt are often the months the hotel is generating the least. That's the trap in scenario 1. The return looks respectable right up until the brand decides it's time to reinvest in itself, using your money. Scenario 2. The distressed acquisition path, the one behind the magnificent mile sale. Instead of building, you buy an existing, foreclosed, 174-room Holiday Inn Express for $16,430,000 or $94,425 per key. Less than 57% of what new construction would cost per room. The brand affiliation transfers with a long-term license agreement already intact. No ground-up construction risk. No years-long entitlement process. You borrow 60% of the purchase price at 7.4% interest, which puts what you owe the bank each year at $793,000. Because the property reopened post-foreclosure with renovated rooms already completed as a condition of the brand retaining its flag, you're not staring down an immediate PIP. Operating at a slightly below average 61% occupancy while the property rebuilds its reputation at an average daily rate of $152, your 174 rooms generate annual gross room revenue of $5,858,383. Run the same fee structure, royalty at 6%, $351,503. Marketing at 4%, $234,335. Technology fee across 174 rooms, $35,496. OTA commissions on a third of bookings at 20%, $410,241. Total leakage, $1,031,575, leaving $4,826,808 in net revenue. At that same 34.8 cents on the net dollar, That's $1,679,729 kept before fixed costs. Subtract property taxes, insurance, and fixed charges the same way, down to 22.8 cents of every total dollar, and you keep $1,335,711 for the year. Subtract the $793,000 you owe the bank, and you're left with $542,711 in your pocket. You put in $6,572,000 of your own cash. That means you got back 8.3 cents for every dollar you invested in year one on a property acquired for less than the cost of building it, with the hardest capital expense already absorbed by the previous owner's foreclosure. The traditional build might generate a larger hotel eventually, but the distressed acquisition returns a higher yield immediately, carries dramatically less construction risk, and starts the PIP clock over on a building that's already been brought up to standard by somebody else's bad decision. Change one assumption in scenario one, a single PIP notice, a single soft year, and the entire model buckles. Scenario 2 was built assuming the retail hospitality math was already broken when the previous owner bought in. That assumption is exactly what let this owner buy the mistake at a discount and exactly why it kept paying off. The Holiday Inn Express was never really a hotel business. It only looked like one because the sign out front and the breakfast bar in the lobby are the only parts most guests ever notice. Underneath that sign is a fee structure that takes over 10% of every dollar before operating costs even begin. A renovation clause that can demand millions of dollars on a timeline you don't control, and a distribution system where a meaningful share of your own guests are quietly rented back to you by Expedia and Booking.com. None of that makes the business worthless. It makes it something different than what the franchise brochure describes. The brand isn't selling you a hotel. It's selling you a real estate holding structure with a recurring bill attached. One that rewards the owner who understands exactly what they're renting and quietly drains the owner who thought they were simply buying a building with a familiar name on it. The families who built fortunes in this industry didn't do it by trusting the brand's marketing promises. They did it by buying distressed assets, doing the labor themselves instead of paying for it, and reinvesting every dollar of profit for 2 full generations before anyone with institutional money noticed there was an opportunity at all. Some people are learning to buy the mistake instead of building the dream. Most owners are still paying full price for the dream and discovering the fee structure only after they've already signed. You've driven past 100 Holiday Inn Express hotels in your life. Same green sign every single time. The question now is whether you understand what's actually paying for that sign or whether you're still just checking in for the free breakfast, the way you always have. And that's really the whole point of this channel. Every business looks simple from the outside: the diner, the gas station, the shopping mall, the hotel. It's only once you open up the numbers that you see what's actually holding it together. If you want to keep doing that, subscribe, because we're breaking down a new one every week.